This is David Russell, Global Head of Market Strategy for TradeStation. And today we'll look at major events for investors and traders. Money is streaming into abandoned corners of the stock market as year-end approaches. Could investors finally be shifting away from megacap growth stocks like Apple and Microsoft? The S&P 500 rose almost 1% between Friday, November 24th and Friday, December 1st. It was the fifth straight positive week, landing the index back near its high from the summer. But the real story might have been deeper beneath the surface. Consider that long-term laggards like real estate and materials rose the most last week. In fact, of the 6 sectors that rose more than the S&P 500 last week, only one has outperformed on a year-to-date basis. It was consumer discretionary. But then communications and technology, the strongest for most of 2023, lagged. Next, new and smaller stocks are breaking out. TradeStation data shows that over 1/10 of the S&P 500 made new 52-week highs on Friday. But none of the major growth stocks were on the list. Instead, there were members of the Dow Jones Industrial Average, like Visa, Salesforce.com, IBM, and United Health. By the way, all of those stocks trade on the New York Stock Exchange and aren't members of the NASDAQ 100. Third, Tesla was the only member of the so-called Magnificent Seven that outperformed the S&P 500 last week, up 1.3%. Meta Platforms fell the most, down 4%. Fourth, CBO's Volatility Index, or VIX, remained near pre-coronavirus lows. The potential sign of risk appetite could make investors willing to own lesser-known stocks. Several Federal Reserve officials spoke last week. Most avoided declaring an early victory against inflation, but other reports made the market think rates will fall. The Institute for Supply Management's Manufacturing Index remained lower than expected as employment and production slowed sharply. The Fed's Beige Book survey of economic conditions also noted slower economic growth, including sluggish demand for transportation and weaker manufacturing outlooks. Crude oil also continued to fall despite OPEC Plus's members voluntarily cutting to 0.2 million barrels of daily production. That could also keep a lid on inflation and support lower interest rates. As a result, the 10-year Treasury yield fell another 25 basis points to its lowest level in over 3 months. That helped pull mortgage rates down for a 5th straight week, according to Freddie Mac. The Russell 2000 Small Cap Index rallied 3.1% last week. The Dow Jones Industrial Average followed with a 2.4% gain, while the NASDAQ 100 crept up just 0.1%. Gold miners, banks, and industrial metals led the charge. Solar energy stocks and home builders also climbed. All of those groups stand to potentially benefit from lower interest rates. 2 of the 5 biggest gainers were real estate companies. Office building owner Boston Properties, BXP, and wireless tower company, Crown Castle. NetApp and Salesforce.com rallied on strong quarterly results. General Motors jumped after announcing a $10 billion share buyback. Chinese stocks performed the worst as the country's economy continued to struggle. Semiconductors, one of this year's top groups, also lagged. Now, let's chart the market. The S&P 500 remained slightly below the intraday peaks from the summer. However, it ended Friday at its highest daily and weekly closing prices since the first quarter of last year. The index briefly tested the September 1st peak of 4,541 and managed to remain above it. That may suggest old resistance has become new support. Chart watchers may view the March 29, 2022 peak around 4,637 as the next likely resistance. This week brings important employment data and a few quarterly reports. ISM Service Sector Index is due tomorrow. Wednesday features ADP's private sector payrolls report and crude oil inventories. Initial jobless claims are on Thursday, along with earnings from Broadcom, Dollar General, and Lululemon. The biggest item is likely to be the Labor Department's monthly jobs report on Friday morning. It includes payroll changes, unemployment, and wage data. Next week is potentially more important, with inflation data and a Fed meeting. Thanks for watching. Please visit tradestation.com for more.